last week's video, we discussed the potential for short-term volatility and examined the long-term trend. The market is in a bit of an air pocket as we wait for the start of earnings season, with little to focus on other than rising rates. In this video, we'll take another look at the likely path for the markets in the short term and check in on the health of the long-term trend. We'll also answer the question, will rising rates sink the stock market? First, we'll look at a summary of this week's economic data and interpretation. This week was another week for record-breaking economic data. Housing continues to remain a headwind, but ISM services surged to a high not seen since 2008. Initial jobless claims dropped to the lowest level since 1969, and we hit the lowest unemployment level in 50 years. Now we'll look at our week in review, where we take a look at the headlines and how they move the market. On Monday, the market rose from Friday's close on a trade agreement between the U.S., Canada, and Mexico. On Tuesday, turmoil in Italian bonds rattled the market. On Wednesday, the Dow Industrials notched a new high on the trade pact. On Thursday, the market declined on rising rates. On Friday, the market continued lower on rate concerns. The market closed down 1% for the week, and the month and year-to-date statistics are provided at lower right. The economy is the strongest we've seen since the 1990s. With the economy so strong, many are wondering if it's too good to last. Before we answer that question, it's important to remind viewers that long-term bullish trends are composed of more volatile short-term trends, intermediate-term trends, and the longer-term trend. There's an important distinction between how we use these time frames. Our investment horizon in the major indexes is based on the longer-term cycles that often last years to even decades. In these videos, we cover short to intermediate-term time frames to distinguish between normal volatility in a long-term bullish trend and a trend change from bullish to bearish. In this week's video, we'll answer the opening question about whether rising rates will sink the stock market in two parts. First, we'll update a slide on this topic from our May 25th video, and then we'll look at the strength of the long-term trend. You can find this video on the Caliber Capital Management channel on YouTube or by Googling Caliber Capital Management and the title, Will Rising Rates Kill the Rally or Create Opportunities? Remember that the market climbs a wall of worry. For months, the worry was about a flattening yield curve, and now we're suddenly worried about a steepening yield curve. Rates are rising from an abnormally low and artificial level, and this is a sign of a strong economy. Let's take a quick look at updates to our May 25th slide showing how stocks can rise in a rising rate environment. The top panel is the S&P, and the bottom panel is the 10-year yield. Both of these charts go back to 1872. Let's start with rates in the lower panel and work from left to right to understand the rate cycle. We start in 1872 with a long-run deflationary cycle where rates are going down, followed by a 30-year long-run inflationary cycle where rates are going up. This cycle repeats over periods just over 3 decades. Now let's look at the S&P in the upper panel. If you're a regular viewer, you're familiar with your market history, and you'll recognize these 3 periods of sideways consolidation in the markets. Now let's look at whether or not stocks can rise with rates. From 1950 to 1981, we had a long-run inflationary environment where stocks and rates rose together. From 1982 to 2016, we had a long-run deflationary period with stocks rising before and after a sideways period of consolidation in the S&P that included the peaks of 2000 and 2008. From 2016 to 2018, we began to see signs of regime change, back to a long-run inflationary environment. Clearly, stocks can rise in both environments. It's a late-cycle acceleration in rate increases that usually sinks the market versus a slow and steady rise from low levels. Remember our slide on short-term volatility versus the long-term trend? How can we tell if we're seeing normal short-term volatility or a longer-term trend change? Instead of trying to predict whether a flattening yield curve, rising rates, global debt, or some other crisis will sink the market, maybe we should look at the strength of the long-term trend. So this week, we'll look at what the market is telling us, and we'll learn about an indicator called the Average Directional Index, which is abbreviated ADX, and how we can use it to determine when the market is trending, how strong the trend is, and when the trend is coming to an end. ADX is a momentum strength indicator, which indicates the momentum or strength of the trend. Technical analysts use this to identify trend changes, such as emerging trends or how strong an existing trend is and how likely it is to sustain itself over time. ADX is incredibly valuable in a trend-following strategy. To understand ADX, let's do some simple pattern recognition. Here's a price chart of GE on the left and NVIDIA on the right. With a quick look at the charts, you can see that owning GE resulted in a loss in your portfolio, and owning NVIDIA generated a profit. You may have owned GE for years. How could we have used ADX to tell when GE entered a bearish trend? And how could we have determined that NVIDIA was entering a strong bullish trend? Let's look at the Adx line for each stock. The table below shows the strength of the ADX trend based on the value of the Adx line shown at the right. If we look at the table, when the value of ADX is over 25, we have a strong trend. So let's put a green line at 25 on our ADX charts. We can have strong bearish trends like in GE, or strong bullish trends like in NVIDIA. The rising ADX values tell us about the strength of the trend, not direction. For GE, we see that ADX crosses above 25 in August of 2017, and a strong bearish trend begins. For NVIDIA, we see that ADX crosses above 25 in November of 2015, and a strong bullish trend begins. Spotting trends earlier could have prevented larger losses in GE and generated larger profits in NVIDIA. The directional movement indicators for ADX help us spot trend changes sooner. The positive directional movement indicator is shown in green, and the negative directional movement indicator is shown in red. Here are our bearish and bullish trends from the previous slide. How can the directional indicators, in combination with a rising ADX line, help us identify the trend earlier? When ADX is rising, which line is on top tells us whether we should favor the bulls or the bears. When ADX is rising and the red line is on top, the bears are leading in GE, and a trend to the downside is emerging. Identifying the trend change earlier allows us to reduce losses in GE. Similarly, when ADX is rising and the green line is on top, the bulls are leading in NVIDIA. Identifying the trend change earlier allows us to enter the bullish trade in NVIDIA earlier and increases our profits. Now that we have a better understanding of how to interpret ADX, what is it telling us about the current trend in the market? We can kill two birds with one stone on this chart and get guidance on the short term and the long term. This is a weekly chart of the SPY with the 5-period moving average shown in blue. Let's look at the short term first. We're above the January high, and notice how we had been holding above the 5-period moving average. The candles were becoming smaller and more indecisive, and recently we've broken through the 5-period moving average. Now, if you look at the breakout above resistance in the 2015-2016 correction, you see that price had to come back down and test this resistance area for it to become support. So that wouldn't be an uncommon pattern to see here. Now let's look at the long term. We'll start at the left side of the chart and see what ADX tells us. In the lead up to the 2015-2016 correction, we see the bears begin leading with the ADX line rising from a trough and the red line on top. The market begins to run into resistance, and we enter a bearish trend. After rising from the bottom in February, ADX begins turning down, and the bearish trend begins weakening. In October of 2016, we retest prior resistance, and resistance becomes support. The black ADX line rises from a trough with green on top, and the bulls begin leading into a new bullish trend. The trend continues through 2017. The ADX line turns down in January 2018, and the bullish trend begins weakening. Red crosses on top, and the bears are gaining traction, but notice the black ADX line is not rising. This means the bullish trend is weakening, but still intact. Now the green line is crossed back on top, and the bulls are leading again, and the ADX line is beginning to turn up. We want to see follow through here. The green line will move up and down, but we're interested in the green line staying above red. And what we want to see is black ADX crossing back over 25 to see the trend strengthen. So if you've been watching and worrying over a daily chart of the S&P, Remember that a test of the January high would not be an uncommon pattern, and we've certainly seen this in many of the past breakouts from corrections. The slopes of the 50-day moving average and the 200-day moving average are positive, and as of yet, there are no signs that this is anything more than normal volatility that a long-term investor should expect. Notice also that thus far, we've held what's called a rising window here. If we step back and look at a weekly chart to get a better view of the long-term trend, the long-term moving averages have a positive slope. Volatility is to be expected and part of a healthy market. If you look at the upper right, the candle for this week is a bearish candle, and the body of this candle, defined by the open and the close, wraps around the body of the candle preceding it. This signals a higher probability of more downside in the short term. Again, where's the January high? If we closed below this level for more than a day or two, we would begin to more closely examine a potential trend change. Staying focused on the long-term trend is the difference between investing and trading. We'll go into next week hoping for the best, but with a plan for the worst and open to all outcomes. Paraphrasing John Maynard Keynes, when and if the facts change, we'll change our mind. But at current, the facts and balance of the evidence in our model haven't changed yet. The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.